Silicon Valley Bank collapse causes panic among Chinese startups. A real crisis may break out. Chinese scholar reveals key factors for a U.S. China war. Hong Kong continues to slide. Sharp drop on a series of freedom indices. Flu surges for a sixth consecutive week in China. Economic stress. Workers reject employment offers for higher payment.
Panic caused by the collapse of Silicon Valley Bank, SVB, in the U.S. is spreading to the Chinese venture capital market. According to the WSJ, U.S. regulators shut down Silicon Valley Bank on Friday, March 10th, marking the bank sector's most significant setback since the 2008 recession and shocking the tech world. According to the Federal Reserve System, FED, SVB is the 16th largest U.S. bank with approximately $209 billion in assets as of December 31st last year. On Chinese social media, Chinese investors and startups are busy sharing related information and discussing how to prevent such a disaster. Although SVB is far across the ocean for some Chinese companies, this incident has a real impact on them. As TechCrunch reported, in the late 1990s, when China was still new to the venture capital market, SVB was one of the first financial institutions supporting Chinese startups, which the traditional risk-averse banks shunned. Over time, SVB has become a popular choice for Chinese startups to raise capital in U.S. dollars and also the top choice of some U.S. dollar venture capital firms focusing on China. However, when SVB announced its intention to sell shares to raise capital this time, venture capital firms urged companies in their investment portfolios to withdraw from the bank. 3 Chinese tech company founders and 2 investors interviewed by TechCrunch said they give similar advice to Chinese startups doing business with SVB. A Chinese tech company founder said, "After seeing SVB's share price drop 30% in pre-opening trading, everyone realized something was wrong. After American investors told me to withdraw my money from SVB, I immediately told the other Chinese investors," he said. Yi Kai quoted an industry insider as saying some Chinese startups have lost hundreds of millions of yuan during the SVB collapse. Sina also revealed that Andy, pseudonym, a Chinese medical startup entrepreneur, posted on WeChat at noon on March 11th, "I didn't expect when I woke up that I would see a bank crash and my life was completely over." Because most of his company's U.S. dollar assets depend on the SVB's existence, mainly used to pay the employees' salaries in the U.S. Many investors also confirmed that Chinese companies listing shares in the U.S. have a variable interest entity, VIE, structure, especially for founders using U.S. dollar venture capital funds, all follow VIE structure. As a result, SVB is the only option for Chinese startups to send their assets abroad. SVB's China localization division is unlikely to be affected for now. According to the SVB website, this bank started operating in China in 1999. In 2012, it formed a joint venture with Shanghai Pudong Development Bank. It is the first China-U.S. joint venture bank to receive a license since 1997. Bloomberg previously reported the joint venture bank had asked its customers to remain calm and said its headquarters operations were not affected.
According to Xi Sheng, the 2 sessions, the Chinese People's Political Consultative Conference and the National People's Congress, were recently held in Beijing. At this crucial political juncture, some abnormalities have appeared for the Chinese Communist Party, or CCP. The first is the looming financial crisis. Wall Street billionaire Mark Mobius recently revealed to Fox Business that the CCP is controlling capital outflows, and he can no longer withdraw his money from HSBC. He warned that if investing in China, one must be extremely careful. Besides making the world realize China's foreign exchange reserves are nearly drying up, this may stimulate a more significant foreign capital withdrawal. If foreign companies leave, China's foreign exchange reserves will be insufficient. If a large number of foreign companies' money is withheld in China, they may ask their own governments for help, causing the West to impose pressure or sanctions on the CCP. Last year, many Chinese banks reported withdrawal restrictions, and now even Wall Street billionaires can't withdraw money. So now there are concerns about whether China's banks are short of cash. Chinese economist Cheng Xiaonom recently mentioned in the program Political and Economic Forefront that China's banks are the CCP's cash machine. So if a local CCP authority wants money, it only needs a call. an official document, and some procedures, and the people's deposits will be taken. But this game cannot be played forever. Sooner or later, the bank's money will all be gone, and depositors cannot withdraw money. Chung said it sounds unbelievable to say the bank's money can be emptied. But in fact, this happened to many banks in China in the second half of last year. Even major national banks' local branches refused people withdrawals because local authorities had taken the money away. They often use 3 tricks to refuse withdrawals. First is shutting the ATMs down. Second is freezing the credit card and the mobile banking transaction function. Third, when depositors have no choice but to go directly to the bank will close some service windows, or limit waiting numbers, and make things more difficult for depositors, such as requiring various documents for withdrawals. Cheng Xiaoneng revealed the situation has improved since the beginning of this year, because China's central bank has released many loans. But sooner or later, there will be a big problem. The CCP now relies on taking people's deposits from banks to solve its financial crisis. But this just turned the economic crisis into a banking financial crisis. Once the crisis breaks out, nothing can be solved. After the Chinese people find they cannot withdraw money, besides the white paper and white hair revolution, a new revolution may occur. The Economist said the Chinese economy's glamour is over, and the fuses of the landmines it planted are burning. In addition to economic issues, during the 2 sessions, the outside world noticed the frustration within the CCP had become increasingly prominent. For example, Li Keqiang said in his working report, "What people are doing, the sky is watching," which was interpreted as an intense dissatisfaction with the Xi Jinping authorities. Frédéric Lemaitre, the French journalist for Le Monde in Beijing, recently reported that an anonymous Chinese international relations expert made a bleak assessment of China's prospects. Chinese media often consult this expert, but he usually refuses interviews with foreign media. And this time he also asked that he not be recorded. This expert said of Xi Jinping, "He doesn't understand the world. Since he came to power, he has managed to quarrel with all Western countries, and most Asian countries." This expert also spoke of Russian President Putin, saying he underestimated the US's strength and made a mistake. Now, neutral countries like Finland and Sweden will join NATO, which is a setback for Russia. And if Putin loses in the future, the Russian takeover will be closer to the US, and the CCP will be isolated. This expert believes Xi Jinping has already lost. As for China, in terms of freedom of speech and political situation, we will even go back to the Cultural Revolution period. He does not think there will be a U.S. China war, because the Chinese leaders have sent money and family members to the US, and they will never have the courage to give them up. According to Le Monde, this expert's opinion shows China's so-called elites are increasingly silent and thoroughly disappointed. Sun Guoxiang, an associate professor at Taiwan Nanhua University, told Da Jiyuan that Xi Jinping consolidated his power during this year's 2 sessions. Still, it cannot last for a long time. Xi Jinping will step down one day. If the ship is only under Xi Jinping's control, it may collapse faster when being hit by big waves. Sun Guoxiang added that Xi does not want the Chinese people to have any chance to rally, or for the so-called opposition side to be born. The more his power is concentrated, the riskier it will be, leading China to an extremely unstable situation. The Varieties of Democracy Institute, Sweden, recently published the Democracy Report 2023. The report shows that Hong Kong's Liberal Democracy Index ranking dropped from 123 in the world last year to 139, falling into the 20 to 30% of countries and regions considered the most undemocratic. Regarding the Electoral Democracy Index, Hong Kong dropped sharply from 134th in the world last year to 162nd this year, ranking the 18th lowest globally. The report mentions government censorship of the media has deteriorated most severely in Hong Kong in the past decade. In Hong Kong, the government's disinformation level has increased, from about 2.5 points in 2012 to 3.5 points in 2022. This score is similar to that of Myanmar, Cambodia, and North Korea. Regarding the Academic Freedom Index, Hong Kong dropped sharply from about 0.7 points in 2012 to about 0.25 points in 2022, and its score is approximately equal to those of Russia, Thailand, and Yemen. Meanwhile, in mainland China, the ranking of the Freedom and Democracy Index remains unchanged, ranking 172nd, or the 8th from the bottom, staying at the lowest degree of democracy in the world. In February 2023, the Cato Institute and the Fraser Institute released the Human Freedom Index 2022. In this report, Hong Kong's ranking dropped from first in the world in 2016 to 34th in 2022, with the rankings of freedom of speech and freedom of association and assembly dropping to 78th and 140th respectively. The report condemned the CCP's national security law, which was implemented in 2020, blatantly violating the one country, two systems policy and ending Hong Kong's autonomy. ECA International, a human resource consulting agency, on February 8th announced the ranking of the world's most livable cities. Hong Kong dropped 15 places in 2022 compared to 2021, and the CCP's national security law is again accused of being one of the main reasons for the fall. China's influenza surge has persisted for another week in this year's exceptional seasonal flu. Official data released by the Chinese Center for Disease Control and Prevention says that the number of patients infected with the type A influenza virus rose to 41.6% starting March 5th, up from 25.1% the week before. At the same time, recorded COVID infections declined by 1.3% to 3.8%. The National Influenza Center of China, or NICC, reported on March 8th that subtype H1N1 drives the outbreak. It is also known as swine flu, which affects pregnant women and young children more severely. Cases of H3N2 are also present, which is less preventable through vaccination. Patients will suffer high fever, sore throat, diarrhea, and even death if not treated properly. The NICC said that in the week ending March 9th, 2023, hospitals in southern China reported more flu-like cases than those in the north. Local media Jinyang Net reported on March 8th that the Binjiang campus of Zhejiang University Children's Hospital was filled with parents waiting for their children to get checked. One mother said her 2-year-old suffered a high fever of 39 degrees Celsius, which did not subside after being treated with antipyretics. The condition continued for some days until the child was diagnosed with influenza A and given oseltamivir, a medication specially used for flu. The hospital also has a 9-year-old who was moved to the ICU after developing severe pneumonia from the disease. Zhejiang Daily reported that the CT scan showed visible white spots on the boy's lungs, indicating inflammation and fluid accumulation, a common feature in COVID patients. Online, people are also sharing their harrowing experiences with influenza A. One person said it was even worse than COVID, saying, "I suffered high fever and joint pain. At the hospital, I saw a little girl having convulsions during her infusion." Another also shared that their son had convulsions after a sudden fever. The comment reads, "He had to stay in the hospital for half a month. Sudden high fever is dangerous. Influenza A is very fierce." One user said, "I tried to rally myself at home for 3 days. My fever reached 40 degrees Celsius today. After taking ibuprofen, it was still 39.4 degrees Celsius at night. I finally came to the hospital for an infusion." So long to the era of hoping to get accepted. Workers in this Chinese village are flipping through options for a potential employer. Kanglue Village, an urban enclave in Guangzhou province, is among China's biggest garment production centers. As the country reopens, factories are ready to get active from their COVID slumber. But migrant workers aren't. According to Sixth Tone, many are walking away after talking with recruiters at workshops. They say offers are too minimal, and they would rather stay unemployed. Zheng Xiaozhou from Hubei province told the outlet he had not found any desirable offer after a week of trying in Kanglue. Before coming to the village, he thought he could find a job with a daily payment of around $100, or 700 yuan. Zheng said, "If it continues like this, I'll barely be able to afford to eat. Workshops have struggled to find workers for years, and the pandemic has only exacerbated the challenge." As a result, recruiters say workers are shunning long-term offers for short-term jobs, which are less stable but come with higher pay. The spike in living costs also disheartens workers. For example, rents in Kanglue are increasing by about 10% yearly, whereas workshop rates have not changed since 2019. Huang Yan, a professor at the South China University of Technology, said, "Refusing to work while the rates are too low is the migrant workers' way of fighting for more rights. But if they keep having no income, there will be a day when they go to work." Another reason behind the fussiness, as suggested by experts, is that younger laborers nowadays are generally singles. Without having a family, they are under less pressure to secure a means of living. However, manufacturers are also under pressure to survive. Last year's lockdowns left China's clothing industry in tatters, along with opportunities for higher salaries. According to a survey, almost a fifth of big factories were bleeding money in 2022, and their losses grew by more than 12% from the year before. A factory owner surnamed Wang said, "It's impossible to raise the wages." She's been running the business since 2013, but the monthly rent for her 2,150 square foot or 200 square meter factory has increased from $1,157 to $2,300, and the unit price she gets from her clients has barely moved, from $1.02 to $1.31. Wang said, "The workers are not willing to accept low rates, and the clients are not willing to raise their prices." She added, "Everyone says that business will be much better this year, but that's not how I feel. I'm not receiving many orders. I can't find enough workers to finish the orders I have,